So you can evaluate stocks based on your overall portfolio and your stock portfolio on size, large, mid, or small cap stocks. And then any of those stocks, whether they're large, mid, or small, can be evaluated based on their style. Are they a growth stock? Are they more of an income stock? And income and value stocks are very related, a little different. I'll explain why here in a moment, so hang on to that part. But we're going to talk about growth, income, and value. If you've looked at, let's say, mutual funds, you might see like a little square box with all these little squares inside it. There's like 9 squares in it, and it might say things at the top. For a stock mutual fund, it'll say, or on the side, depends where they put it, but it'll say like growth in value or growth and income on either end. And really what they're looking at is the style of that stock. What is it related to in terms of other stocks within that style type thing. So Coca-Cola, for example, is a different style stock than, let's say, Google. Doesn't mean they're not successful companies, one versus another. They're both very successful companies. Just how they behave and some things you might use to evaluate them, whether you want to invest in them, might be different between the two. So let's take a look at that. So first, let's look at growth stocks as compared to income or value stocks. So growth stocks, think of those as you're looking for growth. You're looking for the price of your stock to go up, or capital appreciation. You're looking to make money. You're looking for your capital to grow. And so these are stocks that are projected, or you're projecting, or people are projecting, for these stocks to grow and outgrow and grow faster than the market, and in particular grow faster than their rivals within their industry. Whenever you're looking at stocks, think about the industry. Some industries might be growing faster as an industry versus other industries, so you want to compare within the industry. So growth stocks are all about high flyers, right? They're the high flyers that things look great and you want to see them keep climbing and really reach a peak and then maybe sell high later, but right now you're looking to buy and have that really grow. And the idea is that the earnings are things that drive a stock price in a large way, or maybe later will pay out money or invest money into the company again. That earnings are growing faster than the industry and market. That's one way to basically recognize a growth stock, that earnings are growing faster, typically much faster than industry and market. So if you look at, let's say, some particular ratios or things that people are interested in growth stocks look at, they'd be interested in things like along the lines of revenue or sales. Are your sales and revenue growing? How's your cash position, your cash flow? Do you have a good flow of cash coming in? Are you running, you're running below, you're incurring lots of debt or something like that, and you don't have the cash to support that? So looking for cash and revenue that are rapidly rising is typical of a growth stock. They would have a higher price to earnings ratio. What's our price relative to our earnings as a comparison, as a ratio? So these would be high price to earnings ratio, higher than their industry, probably higher than the market. And then a higher price to sales. You're paying for those sales. You're paying a high price. And when I say price, the stock price. So higher price to earnings would be the stock price to its earnings. This would be higher price, the stock price in relation to its sales as a financial ratio as a measure to compare, let's say, an individual company versus others as an example. So you can see the trend here. It's all about high, all about growth, all about, I might be paying a lot for the stock, but that's okay because it's going to keep growing and it's going to be great, And that's the idea, is that it's investing in the company to have that future growth. So typically growth companies, if you're interested in dividends or companies that pay out money directly to you in terms of cash, maybe on a quarterly basis, a quarterly dividend where they're taking their earnings and rewarding you as a stock owner, rewarding you as an owner in the company, a part owner of the company. Growth stocks typically don't pay a dividend because the idea is they don't want to give you that money as an owner, and you should actually not want it. And here's why. They want to reinvest that money into the company because the prospects look so great that we want to keep reinvesting to grow that company. So the management of the company will say, we don't want to pay out that money. We need that money to invest in things like research and development, or research into quality control, or research into new markets, or maybe into mergers and acquisitions and buy new companies or buy smaller companies to help fuel our growth. So it's all about fueling the growth. So typically they won't pay a dividend. A good example of a company like that is one you're very familiar with, is Google, right? Look how the explosive growth of Google, certainly of its stock price from 10 years ago or 8 years ago, whatever, how it's rapidly growing. A very typical technology stock. Technology stocks a lot of times will be growth stocks because you're investing in them with the idea that they're going to invest in new technology and build crazy things like self-driving cars and all that that'll change the world. And when that happens, then their stock price will go up and you'll be rewarded for your patience as a stock stockholder. So that's growth stocks. You're looking to invest in companies that will really grow and grow rapidly versus, let's say, like income stocks.